All right, we'll just do some final review questions here to wrap up this course. I went through the 12 different lessons and just tried to pull out a couple of the most important nuggets from each lesson. So as we look at the first lesson, we got into an overview of financial accounting, and one of those questions, one of the issues that we got into was listing the four primary financial statements. So could you do that? Could you list the four primary financial statements? You can pause the video if you want, see if you can do it. Or you can just watch the solution. If you said the income statement, you got one. Balance sheet, you got another. Statement of cash flows, you got the third one. And if you said the statement of stockholders' equity, that would be the fourth one. So it is the statement of stockholders' equity. Sometimes people will say statement of retained earnings, but that is not the full statement. It is the statement of stockholders' equity. What are the primary forms required by the SEC, and what is their purpose? So we're really looking for the name of the forms here. All right, so what are the names that the SEC gives to these forms, and what is the purpose of them? Well, the first one is the 10K, and that's an annual report. So a company could file its own annual report, but then not call it the 10K, and many companies do that, and it's just they can use whatever format they want. The 10K is a specific report prescribed by the SEC that has to contain certain information in a certain order. The quarterly report is the 10Q. Companies that are governed by the SEC, so again, you're getting publicly traded companies there, you're getting companies that maybe have publicly traded bonds. They will file a 10Q. You actually only file 3 10Qs. You hear a quarterly report, so you'd think 4, but the result of the fourth quarter earnings end up in the 10K. And then the 8K, reports of significant events. So whenever there's a material event that impacts the company, they will have to file a Form 8K for that one. And the scope of 8Ks is really beyond where we're going to go here. So assets, how are they listed on the balance sheet? We're into lesson 2 now. What order are they listed in? It is liquidity. How quickly they will become cash. So we start with cash, maybe some short-term investments right after that, which oftentimes is investments in U.S. Treasury bills, then accounts receivable, inventories, prepaid expenses, things of that nature. Current assets will become cash within 1 year. And similarly, although it doesn't ask it, liabilities are ordered how quickly you're going to have to pay them off, and current liabilities, you generally are going to have to pay them off within 1 year. All right, what are the journal entries when a company is formed, when it borrows cash from the bank, and when it purchases inventory on account? So think about the journal entries. What would they be for the 3 of these? Could you get all 3 of these back from lesson 2 here? Oops, bumped. So when a company is formed, you generally are going to debit cash and credit common stock. We learned in a later lesson that we might break that out between common stock and additional paid-in capital. So, but for right now, just common stock, and then it'll equal the par value of the stock. When a company borrows cash from the bank, it's going to be an increase to cash and also an increase to notes payable. Frequently, it'll say short-term or long-term, depending upon the term of the note. And then when they purchase inventory on account, it's an increase to inventory, then also an increase to accounts payable. That's not a note payable. That's not an account receivable. Notes payable are in the ordinary course of your business. And you'll notice with all of these, assets equals liabilities plus equity. All right, in the first one, assets went up, so did liabilities plus equity. In all of these, assets went up, and on the opposite side, liabilities and equity went up. They don't have to always go up that way, but the change in assets has to equal the change in liabilities plus equity. When are revenues and expenses recorded? This was a lesson 3 thing. Well, when we think of revenues, we're thinking when they're earned, and when are they earned? Not when cash is collected, when goods are delivered or when services are provided. And when we think about expenses, we generally are going to think that they are recorded when they're incurred. We match them to revenues. And what I generally think of this is the event has occurred, which is going to require a decrease in assets. All right, so someone performed services for us, an employee worked for us, we used up an asset, something of that nature. Into lesson 3, journal entries. What are the journal entries? When goods are sold on account and then when the cash is collected. Well, when goods are sold on account, we're going to debit accounts receivable and credit sales revenue. We also would debit cost of goods sold and credit inventory, but we're just focused right here on the revenue side of it. And then when the cash is collected, we're going to debit cash and credit that accounts receivable. So in that first entry, assets went up, as did shareholders' equity. In that second entry, assets didn't change because they went up and down. And liabilities and equity didn't change either. Lesson 3, journal entries when employees work in one period and then are paid in the next. All right, so the first journal entry, debit to wages expense and a credit to wages payable. We will oftentimes refer to that as an accrued wages. And then when we pay them the next period, then we're going to get rid of that liability by debiting the wages payable and crediting cash. In that first journal entry, assets didn't change and liabilities and equity kind of net down to zero. And in that second journal entry, both assets went down and liabilities went down. We go into lesson 4, and that was basically completing the accounting cycle. In lessons 2 and 3, we really worked at just recording our regular journal entries and posting them into T accounts. We then prepare an unadjusted trial balance. We make sure it all balances, debits equal credits, right? We then make adjusting entries, which we'll talk about in a minute. Use those to prepare an adjusted trial balance, which we then can use to prepare financial statements. Once the financial statements are done, we can close out revenues and expenses, and then we have a post-closing trial balance, and that will become our trial balance to start off the next year. All of the revenues and expenses would be closed out with closing entries. They start over at 0. All the balance sheet accounts stay the same, with the exception of retained earnings is updated to account for current year net income. What are the 4 broad categories of adjusting entries? We've got accrued revenues. We generally have performed some services, sold some goods, haven't received cash yet. We've got just deferred revenues. We've got cash but haven't earned the revenue yet. We've got accrued expenses, where we have incurred an expense but not paid it yet, like accrued wages is a classic one, accrued interest expense. And then deferred expenses. There's actually, we paid cash before an activity happened to basically use up the asset that was created when we paid the cash. So it's like we paid cash before there's an activity which is going to give rise to us using up the assets. Inventory, fixed assets, prepaid expenses, these are all examples where we might pay cash up front but not record an expense until later. Lesson number 5, what's a journal entry? If a company sells 10,000 of goods on account and estimates that 3% of that will never be collected, well, this is the percent credit sales method. You just multiply those together. 10,000 times 3%, you got bad debt expense and the allowance for doubtful accounts. You do not, under the percent credit sales, you do not need to know the balance that is in that account in the allowance for uncollectible accounts like you would under the aging method. The aging method is just a different method. I just didn't choose to put that as a review question here. In the next lesson on inventory, assume a company has 100 units in beginning inventory at $3 a piece, purchases 50 more at $4 a piece. So they have available for sale then 150 units at $500, and then they sell 40 units. What is ending inventory of that 110 units and cost of goods sold under FIFO? So under FIFO, that means that the 40 that we sold came from our beginning inventory. So all of that purchase is still sitting in our ending inventory. Those 50 units at $4 a unit, and then 60 units from beginning inventory are still sitting in our ending inventory at $3 a unit. We do that math right there, and we get $380. $480 of ending inventory, and the COGS is the $500 available for sale minus $380 of ending inventory. That's $120. You could cross-check it by just saying the 40 units we sold under FIFO, we sold them at $3 a piece. That's $120. If a company buys a truck for 50 grand and expects to use it for 5 years and then sells it for 15 grand, and then expects to sell it for 15 grand, what is depreciation expense per year? We're going to assume the straight line method. We're going to take that 50 grand minus 15 grand, so they're going to use up basically $35,000 value of the truck over 5 years. We would claim $7,000 of straight line depreciation expense each year. If a company borrows $1,000 for 1 year on October 1st, 2024 at an 8% rate, what amount of interest expense will it show on its 2024 income statement? So if on October 1st, 2024, it borrows for 1 year, it means it's not going to pay it off until October 1st, 2025. So on its 2024 income statement, we want to take that $1,000 and multiply it by the 8% annual interest rate, and it was outstanding for 3 months during the 12-month period. And when I say the 12-month period, that's the 2024 calendar year and not the length of the loan. That's just coincidental, and that'll give us $20 then of interest expense. So we would debit interest expense, credit interest payable, each for the $20. If a company issues bonds with a 5% coupon rate, will they be issued at par, a discount, or a premium, assuming the following market rates? Okay, so just kind of 3 independent questions. So if we got a 5% coupon rate when the market rate is 4%, people are going to want our bonds. They're going to pay more. They're going to pay a premium for our bonds. If the market rate is 5% and that's what we're offering, we're going to issue them at par. And then if the market rate is 6% and we're only offering 5%, they're going to go at a discount. So this just means, let's say the bonds had a face amount of $100. In that first example, we get something more than $100. Second example, we'd get $100. Third example, we would get less than $100. And that's not good nor bad. It's just that we will get paid more or less generally. It's pretty rare that they're at par, but we'll get paid more or less so that when we combine the interest rate that we're giving through our coupon rate as well as kind of the difference between the issue price and the $100 face amount, the investors will end up getting the market rate return. A company repurchases 100 shares of its common stock for $30 per share. What is the journal entry? Well, the debit in that situation is going to go to treasury stock for $3 grand. It's the 100 shares times $30 per share, and the credit is going to go to cash for that $3 grand. If they were to then reissue those shares to the public, and oftentimes that they could sell them back to the public, or oftentimes it means that they're reissuing them as part of stock compensation for the CEO, CFO, they would end up debiting whatever cash they get. They'd credit the treasury stock for however many shares they reissued times the $30 per share, and then there's usually going to be a gain or loss. We're either going to be reissuing them at more or less than that $30 per share. If it's more, it's kind of like a gain. If it's less, it's like a loss. But we don't call it gain or loss. Because you can't have gain or loss on the sale of your own stock. We instead use the paid-in capital, additional paid-in capital account. A company has $100 of net income, which was properly reduced by $80 of depreciation expense. So it means it would have had more net income if it didn't have depreciation. Its inventory is increased by $15 during the year, and it paid $30 of dividends. What are cash flows from operating activities? Well, the $100 of net income is the starting point in that section. We then add back depreciation because it's a non-cash expense. Inventory is increased, and an increase in a current asset is a decrease on the statement of cash flows. So that's by that $15. And then the dividend payment, that'll decrease cash, but it'll be in the financing activity section, not the operating activity section. So 105 is where we'll end up. We ignore the 30 because it's just operating activities here. And then the last question in this review kind of guide here. If a company had $1 million of revenues last year and 900 of revenues this year, by what percent did revenues change? Well, the numerator is current minus prior. So they went down by 100 grand. And then the denominator is the prior amount of revenue. So they went down by $100,000 on a base side of $1 million. Revenues decreased by 10%. That's what we got. Congratulations, you've made it to the end. Thanks for tuning in.